So welcome back. This is episode 17 of the Ground Up Pod. 17. It's pretty mad, isn't it? 17 episodes so far. We release these episodes every Thursday at 5:30 a.m. on Spotify and YouTube. And today we've got a couple of little topics and some questions. We are pressed a little more for time today, but we might as well kick things off pronto. So I'll just start with the Rightmove link that Guy sent in yesterday. So Rightmove have come out with a study just showing the average rental prices and how much they've shot up. So this is what it reads. Build more homes to cut rents, says Rightmove, as average tenant pays £91 more per month than last year. The average advertised rents have reached another new record of £1,316 per month. In London, average rents are now £2,652 per calendar month. Analysis shows 120,000 more rental homes needed to bring growth to 2% a year. And then it reads on, rental prices have reached another new record high, according to the property website Rightmove. So average advertised rents have reached 1,300, which is up 7% compared to a year ago, when the average rent was 1,225. In the capital, average rents are now 2,652 per month, up £92 or 4% from a year ago. In percentage terms, this made it the region that had the smallest rise, along with Wales. And actually, a little shout out to the Northeast. Northeast had the highest rise, which isn't a good thing, but also it's a good thing for investors, but it's not the best thing for renters. And then Rightmove is therefore calling for the next government to build more homes in order to make rent rises more sustainable. And obviously, we're just hearing this is like a record player now and repeat: build more homes, build more homes. I don't think there's much for us guys to talk about there. I just thought it was yes, unless anyone's got anything to say about it. Obviously, we know this is happening.
Well, I've got a question. Is from those stats there, is anybody seeing or know in the past couple of years what the average, I know that's Rightmove stats, but what are you actually seeing on the ground, your end? What's the average kind of rent increases you're seeing in your area? What could you rent the room for 3 years ago versus now?
We haven't had a problem on... Yeah. Oh, 25. Fucking hell, that's high.
I would say it's about 25%. I mean, whether we're building a better quality stock and we're just getting a much more of a premium. But I mean,
do you mean year on year? Or
just over the last few years, yeah, I would say 25% in the jump from every development seems to be that sort of number, I would say, versus what new things used to be sort of early 2020s.
Yeah, up here, we've managed to, whenever we've renewed rents, we've managed to up them 50 quid without really having an issue.
But 650 to 700. You're 600 to 650, aren't you? Or 650 to 700?
Yeah, literally, well, the average rent up here, back at the start of the pandemic, the average rent here for a good double ensuite room, 450, was like, that's good. Now it's that new benchmark's now 650. So
it's, that's 30%.
Yeah, that's big.
Yeah, it's mad.
Yeah,
I would say in my area. Go on, Jack.
I was going to say we haven't seen much change, but we're the like Stuart said, he's a premium stock. He sees better value change, but I've seen that because we're already the top of the table, the increase is marginal, and I feel that the bottom is sort of catching up with the top. Our average room rate, I think, is 875, and I would have said that it's about the same. Interestingly, just to touch on the rents, obviously Labour government are potentially looking at putting a rental cap into the AST rental model of 5%. Which everyone's up in arms about, but I don't think it's the end of the world. In 2024, we saw a change of about, I think it's 6.8% across the board nationally. So I think that's fairly reasonable.
Well, we're seeing in our area, I would say over the past kind of 4 years, rents have probably increased for single let ASTs, buy to lets around here, probably about 8-9% year on year. It's actually shot up quite a lot, but as you say, we're nowhere near the top, so it would catch up much faster.
Yeah, but what we have to remember is in that time, in this time that we're monitoring, minimum wage has gone up, wages in general have gone up, unemployment is still really low, so the people can afford it.
Yeah, but have they gone up as much as rent? I don't think people have had the same increase in their wage.
I feel like salaries have, but then I always feel that at the end of the month.
I took a staff member to Starbucks yesterday, £9.70. We bought like large coffee and a medium cappuccino. I was like, flipping hell, like it's just crazy.
You probably bought one of big cinnamon rolls as well, didn't you, Stu?
I only bought the 2 coffees, mate. I took another staff member to lunch.
Cinnamon roll.
Yeah.
Can I just touch on the rental cap, because I do think that is a fucking horrendous thing for the rental market. The only reason is because I think it sets a really bad precedent, but also it doesn't take into account what happens, because inflation isn't always ubiquitous. They try and say it is, but if there's a rental cap at 5% a year, but you've got maintenance issues, let's say, if you're liable for any kind of cost towards that property, utilities especially, or interest rates, if something happens to the interest rate market, or inflation on wages for maintenance and things like that, then you're less and less incentivized. If your rental increases aren't keeping up with inflation, real-term inflation, then you're not going to be incentivized to keep the property up to date, to pay the utilities, the rents. You're just going to end up handing it all over to the tenant. The tenant's just going to feel the brunt of those things anyway, other than the interest rates, which obviously you can't really factor for as much. I just don't think rental caps. I just think it's only going to be bad.
I got two just on that. Obviously, I haven't read the details, but if they bring the cap in based on the agreed AST rent and say you can only go up by 5% year on year or whatever they or up to, or I don't know how they're going to word it, but the one thing it could trigger actually is quite like a mass rent increase across old stock that you probably got properties in your portfolio now. I know other landlords that do. That people, especially in like single AST houses or even flats, the tenants might stay in them for years, and they may be on historic old rents. Not all landlords proactively increase it year on year, but obviously, if a 5% cap is going to be introduced, it could trigger quite a mass, renewal and rebase and reset across the board,
like the one-child policy in China.
Kind of madness.
Hopefully not as dramatic. But,
we talked about it. We talked about it in a very, very early episode about the like Christmas tree of their population. There's like huge spurts when they were bringing in the one-child policy, and then a huge cutback reduction when they brought it in. So, like what you're saying is, everyone goes crazy upping rents. So the rental reform and guide that they're looking at is it's rental increases on existing ASTs that are existingly sitting. So what that means is, and Dorian, you're exactly right, people can sign an AST and stay there forever and only ever be punished up to 5% per annum increase by the landlord. But then if the AST ends, you set a new benchmark. But what you're getting at is everyone will go a bit stir crazy and go through their whole portfolio, up all the rents before this comes in. So then there's a false economy, which it then ruins the element of the market, and it actually would to some degree be a bit in a market where supply is under demand, and there's something like this comes in. It creates turmoil because the landlords can completely fuck over the whole market and up all their rents, and because there isn't enough supply, the tenants can't do anything about it. So it will do exactly that. It will have a spike of higher rates in rent for the short term while it all settles down.
Where does it stop? I mean, if they put a rent cap on, they put a cap on rent increases, then I'm all for that, as long as they put a 1% increase on energy and a 1% increase on food and a 1% increase on alcohol. You become a communist state, which is the problem. And also the quality of all the stock that we're building. I mean, it will already drive a load of people out, which actually will increase the market rent more than the 5% they cap. You've got to let the market choose, because then you won't have people wanting to put the best of the best in. We were talking about, our stock being premium. Second, you put a rent cap in there, just run it to the ground, and then actually people's quality of life will decrease.
This has always been
the negative effect.
It's always been the problem with Labour. They come in and think they've got the obnoxious mindset, thinking that these politicians thinking they can solve macroeconomic problems that they don't even understand, let alone try and solve them. They come in, put in new measures, fuck it all up, and then they get voted out again. It's just.
I think in today's world, the biggest problem is you can never be right. And the problem with is you can never be right. And those that are upset most about the policy shout the loudest, and it is definitely like minorities in any sector, in any field that can start dictating changes, because we're in such an instant media digital world. Like 50 years ago, if they were debating and talking about policies, nobody would really know about it other than the inner circle. Whereas now, anything that gets discussed goes straight to the news, goes straight to social media, goes straight to groups. Then all of a sudden, you get about 100 or 200,000 petitions against. It's actually probably. I wouldn't like to be a politician. It seems like such a difficult job, and you can never be right. There's never a right answer.
No,
there's not. But getting involved in the free market, like let the free.
I knew that word was coming up.
Let the free market propagate. That's the main thing.
I completely agree. Like what you've got to remember is what they could do is nothing. It's a bit like, you know, if you go into a kid's school at playground and there's two kids fighting, if you leave them, they'll sort themselves out. And hierarchy will form, and you know they'll sort out their differences.
Will they?
What's that book about the island, the kid island? I can't remember what it's called now.
I don't know. I witnessed a few things in my school where they didn't really sort themselves out.
Okay, maybe
one grows up with severe mental problems,
and the one ends in prison.
Dorian.
the other one ends up in prison. Yeah, it's. Go back to the car analogies, Jack.
I completely agree. Though,
yeah, I'm going to stick with the car analogies.
I agree with Jack's sentiment completely. Though, like free market, like the best thing for the government to do is nothing, and think of ways it can step back out of the market in other areas, and that will actually solve the problem. How can it get further away from the free market? And that will actually inspire growth. And that should be a conservative mindset. We've not seen a conservative government for a long time because they're fucking.
I think, sorry to interrupt, but I just think they need to focus on the root cause problem. This comes, as you've already said, supplied. Why do rents go up? If you go to the root cause analysis, like any business owner does, if a problem comes up in the business, they don't try to solve like kind of that top line problem. They go, why is this problem even occurring in the first place? Go straight to the root cause. What's stopping it? Boom, and then you quickly realize that we're not granting enough permissions, especially not fast enough. We're not encouraging new developments coming through, making it too onerous, too restrictive, too capital intensive. We're not making it kind of less riskier, so we're making it more riskier for people. So just avoids investment. We've had this discussion before. Me and Jack and you two guys, we've been fundraising for years and years and years. And some of the funds that we've spoken to, I know Jack, you're exactly the same with this. Private equity, ultra high net worth. You talk about a fluffy tech business, and there's quite excitement and there's money, and you're like, if you can prove with an minimal viable product and you can get one customer, then we could look to fund hundreds of thousands and blah blah blah. And yet then you go, right, I've got this asset that's been standing for 150 years, not going anywhere. It's obviously gone up in price. There's a huge demand. I want some money to basically buy properties, do them up, or buy some land, develop it, and blah blah. And they're like, oh, no, that's way too risky. You know, we're not doing that. Not unless you're like 60% geared and you put the 40%, and you're thinking, that is just not going to happen for any new entry really coming in, is it? It's very difficult.
So what obviously Dorian's touching on there is an analogy we often think about in our business. So when there's a problem, you've got two things. You've got the symptoms and you've got the illness. And what Dorian's getting on about is the rental problem, or the rent. The rental amounts that keep increasing is a symptom. So like you would go to a doctor because you got a bit of swelling, and he gives you something for the swelling. If you've actually got a condition that means that's going to keep on reoccurring and you don't address that, you're going to keep going back and having the same issue. So we always ask ourselves in our business, what's the symptom and the illness? And I completely agree with that. And I think that if there is support, funding, improvements in planning, I was reading a post this morning about another fellow developer got a site on an option contract, and he still hasn't got planning 4 years later. And how can anyone expect any developer or even landowner to sort of move on from their position if it's taking over 4 years just to get the planning consent?
And we got that now. And as you say, Jack, just building on your analogy, it's like being given hemorrhoid cream for an operation. That's really what's happening, isn't it?
You had that before?
No,
I experienced that now.
I don't know why. I don't know why. It's just how Jack was saying that just popped into my head. And sometimes you should keep those intrusive thoughts inside. But fuck it.
Fucking hell. All right. Well, yeah. I mean, that's our section on on rental prices. What a ball ache! But I think we could go on for ages about fucking.
Should we play a quick game though? Let's just assume we're general public. We're not in property, and we're in a rental property in wherever it may be. Dorian's in South Wales. Ryan, you're in Darlington. Stuart, you're in nice parts of Surrey, maybe, and I'm in Oxfordshire. You're in a relationship. You're looking to go into a rental property. What would you do to sort of protect you and your position and your, I suppose, rent investment to make sure that you're not just with the masses? Like, what can a consumer do to protect themselves? I suppose
rent a bigger house and then rent one of the rooms out separately.
Cool. I think the allowance is it £600 per month, tax free in subletting a room.
You know, so if you need a 2-bed house, go and get a 4-bed house. Yes, the rent won't be double, but obviously it'd be significantly higher. Or even a 3-bed house, depends on the size of the bed, and then rent the extra space out. If obviously that assumes you don't have a family, it's just you and a partner, which is what
I think you're touching on literally a phenomenon that's happened in London in a big way in the last 5-10 years, and that is that you just move in with your mates. You and your mates go, let's go find a property together, rather than me and the missus going to go find somewhere. You go, me and the missus and my mate and his missus are going to go rent a 2-bed flat together because we just can't afford.
That's what you did, didn't you, Ryan? When you was like 12 years old and you rent a mansion with your friends.
Basically, yeah, and fucked it up big way. Cost us a lot of money.
Imagine being the landlord and Ryan and his chums come over, no facial hair. I want to rent this mansion.
Exactly.
All right.
But it is cheaper when you're sharing with people. It's just a lot cheaper and less risky because unless they move out and ditch you with the rent. So careful who's the guarantor in that scenario, you know. But yeah, I'd say share with people.
I was just looking for, you know, in America, like in the 50s, when you had the wife, the husband. Am I not on mute? When you had the wife, the husband, the dog, and 3 kids, and the one bloke would go out to work, you know, and it would be enough to sustain everyone's lifestyle on one salary. And now I'm just hearing everyone talk about moving in with their missus, their mate's missus. I'm thinking all you're doing is you're just compressing the whole economy, and you're just basically doubling. Like, you can't now afford to live even with your partner on 2 salaries. You now need 4 just to pay the rent and to have a decent lifestyle. But what are people willing to give up? Because in those days, you didn't have the cheap flights, the holidays, or the experiences. I think, you know, the Gen Zs and the alphas, their lifestyle is not about buying a property because it's already unaffordable for them. They just now want to go and experience life the best way they can, which is, you know, fundamentally, is that what society and government have tried to build, is a consumable, debt-based society. It's let's take away all the assets that have got value and we'll suck in all that energy so we can keep total control. And what we'll do is we'll give them a lot of cheap flights and airfares and tickets for you to go and experience life, and keep spending it in debt, and then work harder, and then you can't actually afford your own room. 1 minute you'll be sharing a bed with your partner and his missus because you can't afford the room. And that's Stu, the way it's the way it's going.
But Stu, it sounds, when you say that, and I completely agree with you, but there's people out there who aren't, you know, who don't look into this kind of stuff. They don't think about government. They don't think about subsidy. They don't think about agendas. They'll hear what you said. No. But they'll hear that kind of conversation and go, that sounds very conspiratorial. Like, of course, that they're not doing that, but it's not that there's people sat in a room going, "Oi, how can we keep them distracted? Let's make cheap flights." Blah 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 blah.
Yeah.
It's policies incentivized by the voter base to the politicians who are going, right, we need to make sure people can travel, so let's make sure we're subsidizing Airbus and British Airways and whoever else because the populace will go crazy if they can't go on their summer holiday. And these incentives over time create an ossified society with what looks like an oligarchy regime at the top, because the people always want stuff that the politicians can't actually guarantee. So they subsidize it, which means there's more debt, which means shit gets more expensive, the disbalance of our debt to GDP, and then we're not building enough homes because they're overly invested into our free market. And we wonder why the world gets worse, because government just get involved. If the government just fucked off, we'd be all right.
We've done what episode? We're on 17, right? So for 17 episodes, I've banged on about a load of different things where 5 years ago, I had no time because I was so distracted in running one business, which was before the pandemic. And then I was almost enlightened on the basis that how can this world exist and how can people still exist when no one's going to work? You know, we had 6 months of no one working. The economy was zipped. And the way they done it was printing money. And I understood that. When I understood that, I started looking into it. I become obsessed with it because I was like, how the hell can you keep a global economy running on no steam, no coal, on borrowed money? And then I was like, it just didn't make sense. And I remember when the 08 happened, I was thinking, shit, we're all screwed. And then this happened, and I was like, how can all the stocks and shares be up 30% when no one has gone to work? All my guys are sitting around trying to ask to do some bits and bobs, and it just become an obsession. And then when you look into it, you don't have to peel back too many layers to go, this is all a scam. The whole thing is a scam, and there is a revolution coming. And I'd just like to put a quick plug out there, but there's a YouTube documentary. It's been built by the Bitcoin community. It's so good, because when you actually start getting into this and you have no idea where to turn, and there's a load of scam artists and you don't know who to trust, but actually this video that's been made by sort of 7 or 8 key players in the Bitcoin community, I've sort of organically found them through YouTube and watching them and trusting them, and now they've all got together, and these are well successful people in their own rights, well ahead of Bitcoin anyway. And there's a YouTube documentary called God Bless Bitcoin. The challenge is to get 1 billion people to watch it. So we'll put a link in the description downstairs. If you can find an hour, they've basically simplified the model. They've simplified what the first principles of what Bitcoin does, and it will actually expose it against the existing system. And it's a difficult mindset, because you've been so brainwashed into thinking that we were born into the dollar, we're born into these fiat currencies. And when you peel back a few layers and go, actually, and you ask the question why, then it leads into more of a religious point, which, to be honest, the fact that no one knows who Satoshi was, I'm actually believing it was built by some greater being, because it's so good and it's going to change the world in such a paradigm shift. It could only be created by someone a bit more. I know it sounds very culty, but I know Darren's thinking, fucking hell, he's brainwashed.
That sounded fucking terrible.
God made Bitcoin.
I'll tell you what, mate.
Divine intervention.
Someone was sent by heaven, because when you get to the end of it,
I swear to God, in 3 years' time, Stuart's going to be in some form of temple. I
feel like Bitcoin is Jesus, mate, and I'm one of his disciples, mate. I'm out here banging the drum. In a decade's time, it sounds insane, right? But honestly, when you look at how good Bitcoin is, and what they took all the religions and they take all the key phrases from each religion. They have someone from the Jewish society, someone from a Hindu, someone from a Muslim, all these different cultures, and they compare it to what they believe in fundamentally that's 2,000 years old, and Bitcoin ticks every single box, and it's super powerful. I was in a car with a mate. We went 4x4 in last weekend, and we spent 20 hours together, and I was with him in Dubai, F1 experience, when it was at its all-time low, and I was like, just buy one Bitcoin. It's 13 grand. You can afford it. Take your money out of cash and put it in. He was convinced it was 30 grand, and we were in no 4G. And I said it was 13 grand. He said it wasn't. It was 30 grand, 30 grand. I showed him it was 13 grand. He's like, shit, I should have bought something. It was only 2 years ago, and now it's 60,000 or it's now 70,000.
For those that are listening, I know, firstly, Stuart, I've always admired your passion, but I've actually seen firsthand that Stuart actually walks the walk. He's got a significant crypto holding, which I've seen firsthand. So it's only that reason I actually listen to him. If it wasn't, then I think fucking what a wacko. But no, I know you genuinely do believe in it, and have genuinely invested a huge amount into it. So
well, it's my time and energy, I think, rather than the money. I don't think I've got a significant amount. I've got an amount where people would lose a bit if it was to drop 60%. But
don't you think, though, from a percentage of your overall net worth, just from that ratio, rather than a number, the percentage of your overall net worth, like you are classed as heavily invested in it? Would you agree with that?
Mentally, I will think about it every day. I think about it equally or even more than what I do about property, because property was a means to create an income that could then buy me into this paradigm world and universe, which I think I'm already living in. I'm already comparing all the prices I buy in Bitcoin and what Satoshis would buy me. And until we go to a place where all governments are fighting for me and my time and my business and my economic energy in their state, when it becomes effectively tax-free and you haven't got to pay capital gains, that's where my time is living.
Might be an interesting exercise to go around the table and everyone say what sort of percentages they're invested in what category of investment.
Yeah.
Yeah. So I'm 99% invested in my actual business. Like the business owes me money. I've invested absolutely everything into it. It's quite a capital intensive business. It takes quite a long time to get a payoff. So that's one of my biggest problems, as we was talking about before, of why I struggle to diverse into other investments, because this business is growing quite quickly. There's huge opportunity, and in theory, the percentage return on capital employed is extraordinarily high from a percentage point of view, should it all come off, which was obviously the intention. But yeah, because of that, I'm 99% invested in my trading business.
Yeah, I'd say I'm probably 95%.
So I'm 30% in debt, which is good debt, which is a lot to property. I don't actually look at property as I own £1 million worth of property and I've got £1 million worth of asset. I'm 70% in debt on that model because the debt is going to debase. So 30% in debt, in good debt, not in credit card debt. I'm 30% in Bitcoin. I'm 25% in property, and then I'm the balance. I'm 0% in cash. Literally, I've got 1 month's worth of cash in my bank all the time, which will pay for the short term, and then I've got probably 5% in ISAs, and then the rest is in stocks and shares, which is in my pension. So that's where I'm at, really. Sort of pretty diversified in different things, but ultimately I think my Bitcoin holding will become the biggest thing because it's going to swallow everything else in terms of value per Satoshi per economic purchase.
Right? Did you say 95% business and then is the other 5% Bitcoin?
Yeah, basically Bitcoin business. I said 95% because the only stuff I put into Bitcoin is any surplus I get from my personal income from the business, and I don't take a big wage, so it's just incrementally over time. So really,
I'm
property first.
I'm actually pretty much 20% XP surveys, 20% Central Suites, 20% XP property, 20% our social business, and then the rest in sort of sat boring assets that are knocking around. And then I mean that's pretty much my spread. But I think that for listeners out there, we're all pretty invested in our businesses because we're in growth mode. I think once your business is out of growth mode, it should be paying down to some of the maybe cash investment that you have. But in the nature of the world that we're in, which is development or property, that you naturally is almost impossible to not build a portfolio as you go along, even if you sell.
When do you stop growth mode?
That's a good question. Sorry, there's just a quick question before that. Good question, Ryan, is because Stuart, you touched on it. Go back around the table. How much do you guys keep in terms of a monthly operational expenses as a cash buffer, or how do you define a safe cash buffer that you like to keep?
I mean, I've got what we should have and what we do have. We should have 3 months. usually goes down to like 1.5 months. Okay. And then there's always a bit of a frantic rush, but that's just because of growth mode.
Yeah, we basically every Friday £5,000 comes out of our checking account or current account, and we'll go into a high yielding savings account, which we can get to immediately with Virgin. So that £5,000 a week goes out all the time. And then that actually allows for if there is any cash flow issues in the business, me and our accounts team will have a chat and they'll say, I need you to transfer 40,000. And my first question is why? And it'll always be around the VAT period, because obviously the reverse VAT is changed things slightly with the way we use our cash flow. But there would always be around a 200,000 surplus in there is what we would like. And now we're at about 50 because we went into this world called developments, which is there's so many other bits and preliminaries that when we start on this journey doing these bigger schemes, there's bits that I just didn't even know to think about. There's so many other costs that are between sort of 6 and 10% of a cost that you can put together until you run the 2 or 3 of these things and go, shit, we need to allow for these things. So we're relying on Skylofts to buffer us out of a 30, 40, 50 grand problem, which is fine. I mean, it's all built into the lot. The numbers and the GDV were probably slightly reduced a little bit versus what we thought, but we're still making profit. But what we are learning is 100% of the lessons learned. So we can then build this into I've just taken a new QS on who his only job is to make sure that we have got every single cost using historical data we've already built to make sure every one we're building forward is going to be as accurate as we can be. But yeah, you need that cash buffer. Otherwise, if you didn't have that, you'd be fucked, or you'd be going out trying to raise more debt. And if you don't learn your lessons, then that's how you can spiral out of control.
Perpetual.
Yeah.
What about you, Jack?
Yeah, we're in exactly the same answer as you. In theory, 3 months, but it never is, because we go, oh, that looks cheeky. Have a bit of that. And in our world, there's always, it's almost incestuous how much money lending for like petty cash goes around. And so yeah, I've got another business which is a money business, and they're always 3 days short of money, and then we lend them a bit of money for 3 days, but I put it like, so we earn 100 quid a day after 3 days, and it's not a large amount, just enough to get them over the line, and then it always takes 3 weeks, so it's worth us getting the 40% return on the cash that we've lent them. But I'm always taking little positions like that in the short term. But yeah, we always have to move money around, all the time. And we're very lucky. We've got a team member who's really on the pulse, got access to all the bank accounts, and goes, we've got a little bit of a grey area coming up in this company that, you know, what can we do? Do we need it in that entity for 6 weeks? Then we move it around. So something we need to improve on is stop getting distracted and going, oh yeah, we'll have a bit of that or have a bit of this. But yeah, in reality, probably only every 4 weeks at the moment.
So the growth question then, it's always going to be an individual question, isn't it, for whatever your plans are, your business, but it's something that we've been trying to tackle at the moment by stopping building our personal portfolios aggressively, focusing more on the clients' portfolios and the trading vehicles, just so we can try and like have a bit of breathing room for a while. Capital requirements, not necessarily cash flow requirements, because that's always going to be a problem, but the capital requirements that are the big fucker that cause a lot of cash flow problems. That's where we're sort of at as a business, to try and like, okay, I feel like growth is something, we're keeping the trading vehicles, but for our portfolio, we just want to step off a little bit. I say that, and we've literally just bought another one today as on a JV. So I literally, we can't stop ourselves. But what would you guys say about, you know, when do you think you're just going to just step back off the pedal a little bit on growth to try and consolidate, try and get that 3-month cash buffer back? Because in a bad market, that can be a problem. We've just seen Japan have a huge problem in their market. You know, we're not safe. We're not safe here. Yeah. So what would you guys say about
that? So for us, I've been banging on to Ben. I keep saying I want to get our business into a cash flow positive position so we don't have to do any development. And what that means is our business can sit there, observe the market. Not that we would ever do that. Pay all of our overheads, all of our staff and everything, and come out at the end of the year still making a profit, even though we haven't done a single development. That's the sort of tipping point for me, where we can be more selective, do higher margin deals, be more patient with deals. Whereas currently we're feeding a furnace. We have to do deals to feed the business and grow the business. And I think that all evolves around sort of stress levels and risks. So for me, it's not about what size is big enough. It's about managing that level of risk through the business, because while you're growing, you're taking on risks. You cannot grow really without taking risks. So for me, it's about balancing the risk level and growing more of a exponentially compounding business with less risk is more important at a turning point. Now we've sort of got the engine running and grown to build that engine. And now it's, you know, I said to Ben an analogy the other day, and sorry to for your news, Dorian, it's not a car one, but it is a vehicle one. I said we've spent 7 years firing the coal into a steam engine of a train, and now it's time for us to sit back in the carriage and look out the window and let the team fire the coal in the engine. So for me, it's about balancing the risk aspect, and yeah, I think we're at the tipping point. We're with everything we're delivering now is the size we were growing to, and we can expand and contract. Our business could probably deliver anywhere between 20 to 80 million in value of stock a year. And I think that's quite a good size. Our development company isn't one of the businesses that we want to take national like Dorian does. So that's our aspiration. So we're pretty comfortable as we're at.
Are you saying 20 to 80 mil that's a big delta for what keeps you in business? Like, is that what you're saying there? 20 to 80 mil will sustain the business and you won't have an issue. You don't need to hire more staff up to 80 mil. You don't need to fire staff at 20 mil. Yeah.
Correct. That's how we can, because everything we don't have construction in house, so we can expand and contract in that range. We could actually do smaller. We could run the business on about 10 million in delivery, which for us is a site or two. So or you know, if we end up doing a large multi-story development that might be 20 to 30 million, that's a large chunk of the 80 million, and we can easily deliver up to 6 schemes a year. So yeah, that's where we're getting at, and we've always been on the model of having a core in-house team and having the construction as an outsourced entity, because then we can expand and contract with quite lean overheads.
Yeah. What about you, D? You don't like?
So I sincere apologies. A staff member came in. What did you say?
Staff. Growth. When are you going to stop growing your business? When are you going to plateau and be more boring?
It's a great question. I don't know if anyone can see, but my map is there on the wall. Oh God, I am messing that right up. Whoa, that's a bit awkward.
This bit.
Don't they say don't do live TV with kids, animals, and Dorian?
I've broken my webcam.
Yeah, that's what I'm on about.
Oh, God's sake. I was just trying to show everyone a map. But anyway, either way, there we back. Oh,
you're back. Oh, that's better.
Right.
Perfect.
Hallelujah.
There he is.
Okay, yeah. So growth. So the theory is I've got quite a large growth plan, and I don't know. I don't think I'll ever. I don't want to stop growing. But one thing definitely that's happened is I 100% agree with everything we've already said previously. I want to reduce any trading business debt to to as low as possible or as cheap as possible. And I want the business to grow at a good rate, but a self-sustainable growth rate. I want it to grow cash positively whilst also, paying myself, a respectable amount as well, rather than me having to invest everything. I've basically dedicated my whole late teens and 20s to, business. And I think that's fine. I think you've got to do that. But I think as I go past the 30s in a couple of years, I want that to start turning back around, and I still wanted to grow, and I'm still very ambitious. And ultimately, I think to myself, I'd very much love to run a national company and even a global company. But I will not sacrifice cash flow, in the future for that. If that makes sense.
Mm-hmm.
Yeah, got you, mate. Stu, what about you, mate?
That's the biggest thing.
I don't think I'll ever stop growing. I think that you've got to be able to expand and contract in a heartbeat, and the business will grow. Like we've just gone through a big contraction phase through the pandemic. Even though we've taken on other things, we've gone into development. Now we're going to that expansion period. I think it almost runs with the money cycle, but effectively, if interest rates are going to crash in a minute, interest rates are going to come down. Inflation should drop quite considerably, then there's going to be a lot of money, which means it's going to be house prices immediately already coming up 2-3% because they've had no growth for the last 2-3 years. So I think we're going into that expansion stage now. It's taken on 2 new hires over the last 6 months, and we're going to really start implementing any cash we have got into our systems, because we're going for that death valley, which every business does. When you're going from one phase to another, we're trying to now scale up at sort of 4, 5, 6, ideally. What 4 is our target, but 6 is where I want to get to. These are 5-7 million pound developments that we can run with the same building type. We put in at the front end and we spit out between 6 and 12 flats at the other end, and depending on our strategy. But we know we need some key personnel to make sure they're accountable for those processes. So now we're going into that investment stage. But I believe it's the right thing to do. And if it's the wrong thing to do, then we'll contract and we'll realign. But I think we've got the next 6 months to 12 months to really nail that system. And if we can get that right, then we'll go into a different league as a company. And with every one out of the 6 we do, we're ideally going to sell 4 and keep 2. So that's really where we feel like the balance is. The 2 we do and keep will own 100% of, and we'll use the profits from the ones that we've bought and sold. That we've used investors' funds and stuff, that we'll agree all this up front. We'll sell those 4 and we'll keep the 2. And if we can build a system that allows us to do that much turnover, and that puts us in a different league for the next cycle, which will be 2028.
Well, Stu, you got this bad boy here, mate. So actually really interesting one for anyone running a business now in the UK. Bitcoin cash accounting and all kinds of other fun stuff. So do you want to just say a couple words on this, mate?
I've not looked into the regulations, but I know that last year the UK were totally anti-crypto, and obviously with Donald Trump speaking at Nashville Bitcoin, which was last week and a half ago, there was huge. Bitcoin pumped to 70 and it dropped to 48,000, and now it's back at that 63,000. So there's loads of volatility, but you need it in a market. Nevertheless, Jack Mallers, who owns Strike, is now launched in the UK. So there must be some regulation change that they've been working on, which effectively means you can take your cash reserves from a company and you can put it straight into a Strike account, which means they will store it in Bitcoin, which means for accounting purposes on your balance sheet as a business, you can store Bitcoin. So if you've got any surplus cash that we're talking about, effectively that $5,000 a week that we put into a Virgin account, we'll be putting 2.5 grand into Bitcoin and 2.5 grand in that account. We can still sell the Bitcoin. I haven't looked into capital gains, which is obviously a personal thing. But if there's no capital gains inside a business, it's just whatever growth you've made, you pay you pay corp tax on that gain. Hopefully it's 20% if that's what it needs to be. So I've not looked into enough of it yet, but it's a great start because it also means you can set up multiple businesses and put multiple funds that you can afford into Bitcoin. Once you've learned what Bitcoin is, this is a huge milestone. You can see there the amount of countries that are now accepting and adopting to Bitcoin, which is a global takeover. But it still goes back to what I said at the start. Learn how to store Bitcoin securely. I've just said, obviously Dorian's just said I've got a significant amount, but I can't actually get to my Bitcoin for safety. It's with there's companies out there like Bitcoin Suisse who actually manage and maintain. You can have a window in to see what you've got, but you can't physically get to it for security reasons. But yeah, learn about Bitcoin, understand Bitcoin, spread Bitcoin with love, and it will win. And and I just think it's another reason to. This thing is not going away. This is going to get stronger and stronger and stronger, and everyone gets Bitcoin at the price they deserve. So the quicker you learn about it, the quicker you're gonna benefit from it. But ultimately, it goes up forever. It's the power law, and it's Metcalfe's law, which is a network effect. You can't stop 100 million people using it. There's 8 billion people in the world. It could go up to a $900 trillion asset, and at the moment we're at $1 trillion. So you can do the maths quite easily where it's going to go.
I think it's worth adding as well that Strike work on a Lightning payments network, so you can receive and send dollars, euros, pounds, and it can be converted cents into Bitcoin. So it actually it's different than just Coinbase coming to the UK or anything like that. The fact the UK have actually allowed this, and as you can see on the map, a lot of big countries have allowed this when it really is competing with bank networks and the SWIFT network and things like that. So there's quite an interesting transition that's happening here, just in the way that we transact funds between each other, between entities, and Strike is sort of blaze trail in the path there for everyone. So it's well worth looking into. And if you want to put a few £100 a month or $1,000 in to start seeing what cash accounting and Bitcoin looks like, get some experience in it, can't hurt.
In this video, in this documentary, God Best, I wish I could share my screen because I've got the clip here, but I don't know how to do all that. But ultimately, there's a lady called Kathy Wood. She's an investment company called ARK Invest. She actually explains that there's 9 points from point A to B. No one thinks about when they use their Visa card and they pull it on credit. Everyone's getting paid along that chain, and there's up to 9 people that get paid, and it takes 3 days, and you can't do it at a weekend. Where with Bitcoin, because it's peer-to-peer, it can happen 365, 24 hours a day, and it goes from point A to point B, and it gets pushed for no fees. If you use the main base lane, which is expensive, which is obviously a 10-minute block that's created by Bitcoin, there's a fee for that. But when you use layer 2, which is the Lightning Network, it's friction free. It costs you 1 cent in, I think it's like a cent or something to use. It's so small, but it means you can make the coffee transactions, and every 10 minutes the transactions on the Lightning Network get built into the main blockchain layer. But there's a whole sort of there's a whole sort of 3-4 minute piece on that in this movie. So definitely watch it.
Lovely stuff. And now, Jack, you had this question come through to you from Ami Sharma. I wonder if you wanted to take the lead on this one, mate, because it's quite a contextual question, isn't it?
Yeah, I mean, to summarize it, he's got a site. He's been battling with the planning, but it's looking like hope is on the horizon. Good luck with the planning. But the questions are really on a development site, which, just to give you a little bit of context, it's an office that's being converted to be 8 flats and retain a small bit of the office for an accountancy company. So it's technically going to be a mixed-use building. But the questions are there any tips for the next step of the process? Building regulations, finding a contractor, agreeing a price with a contractor, and things that Ami should be aware of with regards to development loans. Also, is there anything you can think of that is going to jump out and surprise me further down the line this process, like the bats, for an example? And he's based in Surrey. I mean, all valid questions. Should we go around the room to answer? What we're getting at is pre-construction, tendering, and funding, I suppose.
Yeah, I'd say you want a good you want a good local designer. I'd say initially, if you don't know anyone, you want to try and find a good architect or design practice, ideally locally, who's dealt with who knows local builders and other resources you can utilize. Unless a developer. So if you know someone in the game, then see what resources they've got. If not, try find a good local architect. You go on the planning portal to see who's delivered different shit in the area. You might already have an architect that you want to use through the construction phase as well. See if you can get them to perform the principal designer role, so they're reliable for bringing in all the design packages together. And ideally, they would have rapport with other contractors, or can at least point you in the direction of other contractors. It's kind of how long's a piece of string with this stuff, though, because you could attack this from a lot of different angles, but you need to get the designs done first before you really engage a contractor. But you equally want the contractor's input on those designs to make sure the architects, if you don't have construction experience yourself, You don't want the architects getting all pencil happy with designing all this quirky shit that's then going to cost you an arm and a leg to build out. So there's a bit of you kind of need both to happen, but you really need competency from a design practice. That's your M&E, your civils, and everything else that comes with it, not just the design and the regs. How the architects spec the regs. You don't want the regs you don't want them just to go standard, follow the BICS guidance, because then you can end up putting in gypsum C-stud when you could get in a much cheaper branded C-stud. And there's all kinds of things in there that you want a good, competent designer to help you on with cost and efficient design. That's what I'd say for now.
I'll go if you like. So we're going through exactly this. I think that reading that high level it's the fear of the unknown. And if this game was easy, everyone would be doing it. And the fact that it is complicated and there's loads of steps, and you have to come to terms with the fact you're not going to know everything. So we're going through this exact process where I wanted to try and keep everything in house to keep the control. That was a mistake because we tried to save costs and keep control, but realized we were totally underqualified in this area to do the best job. So we're now building an army of the best we can work with and the best that will listen to us and the best that will help us move forward. So really selling where we want to go and trying to bring them on board to get us there. And then what we're doing in-house is we're now building effectively a master mainframe in a chronological order from the point of which the inquiry comes in to the point of which it's finished, refinanced or sold. And that is really the art. So I'm trying to bring the best people in now to help us build that so we can build all our systems. It's a lot easier when you start, because if you start and you can rely on people or watch people who are doing it, and you can sort of base a blueprint of one that's right, then you can work to that and then add it and adapt it. And this is where your systems come in. But ultimately, we still don't know all the reports that are needed for every single type. We can try and focus on the right building type, which hits 90% of those things, and remove the risk by trying to keep the same buildings being put in at the front end rather than buying this, that, and everything else, which, if you're doing different planning apps in one area, then Class MA on another, and different building types come with different risks, and part new build, part conversions come with different building regs. Try to focus on one type and just become a master of that. And that will give you a good foundation to then add new different types of property to it. It is definitely an art, but yeah, you just got to admit to yourself you're not going to know everything, and then or use a good EA or someone who has done it and just build in 100 grand worth of cost to say, look, I need you to help me with this, and then use and rely on their network. If I was doing it again, that's what I'd rely on.
And what about you, D? What would you do, man?
Yeah, I think if this is their first development, I would, as Stuart said, they've obviously got an architect on board. You don't really know how good that architect is until you're going through the actual construction phase. But most importantly, for your first one, get a good employer's agent to help you. They will help you. You're only gonna really be able to know what reports and what happens in terms of process and timescales and costs once you've gone through it once. So to really de-risk that, you need a good employer's agent, and try to get one that's come from a recommendation from an existing developer in your local area. But they will help you with the budget. They will help you with the job itself. But then, as Stuart said, just take that. It's not going to be entirely accurate. But then, most importantly, though, they're going to help you with the procurement. So they're going to go out to local contractors in the area that they know should be able to deliver it. They will also be able to advise you on the best way at the procurement contract. So, if it's your first one and there's risk and you don't really want anything hidden, if the prices come back in well for design and build, so to speak, so the contractor is agreeing to take all the risk, or the vast majority of the risk, then you may be comfortable to do that. And if the contractor that they recommend, you can be as involved as possible with the employee's agent. So be sat in with, review the tender pack, sit in on the pre-start, sit in the project review meetings, because they'll obviously help with the contract administration during construction as well, and the valuation, cert and process, and like I said, that the project review, the monthly updates. If you can get around that and be asking as many questions as possible, by the time that job's finished, you'll learn so much about what come up, what was needed, how a valuation gets drafted, how a contract gets drafted, how a CSA gets drafted, what the employers' agents look for, what they look for when they go to site and they start certifying, what comes up in a project review meeting, how do they know if it's on track, what do they do if it starts going off track. And if you could do that ideally with a fixed price, D and B all in, then great. But if it doesn't work, you have to go to a more traditional contract route, then just seek as much advice as possible about what potentially could be missed. And if it is a conversion, which I think this is, really consider and get advice as well from your EA about you doing the rip out phase yourself. and then go into main contractors for the rest of the job, because that's typically, and the other guys will be able to confirm, where a lot of unforeseen with conversions come in, is when they get priced before it gets ripped out. And then when they rip out, they realize actually the walls are fucked, the floor's fucked, everything else, everything needs upgrading. So you may as well just bite that rip out stage, which is basically labor and cat away. And then I'm trying not to complicate it, but that's really my advice for the first one.
To Dorian's point quickly, to Dorian's point, there's actually companies out there who play this game where they actually bid low and then they try and make their capital on variations. So there's a whole world out there where they've got companies with departments that their only job is to squeeze the developer for as much cash as they can out of a job of unforeseens. And that's the way that they operate, which if you've got a real strong, robust contract and you've done a deal with these contractors and there is no movement, and they are overexposed and they're relying on that extra variations, then that's where they get into a bit of a risky position. Obviously, I was with a friend that we all know this week for a quick lunch, and he had a real robust contract with the main contractor, but the subcontractors that they were using, it was completely wishy-washy. So when this main contractor went bust, real issues exposed themselves where no one underneath them, the underlying contract between the other subcontractors, was not in position. So that's where millions and millions of pounds was lost, and ultimately the job didn't end particularly great. So you just need to make sure that I work to 80-20% rule. So if I understand 80% of it, we'll do it. And there's always going to be 20% worth of risk, and that's what you take. And if you take a development on and there is no profit in the job because the 20% has swallowed everything you've had to learn, you've come away with no money but a shitload of lessons, and you'll decide whether you want to do another one and take all that knowledge to try another scheme, or whether you call it a day. So if it's 80%, you understand 80% of it, I would do it and just take the risk on 20%, but dig deep and keep learning. Sorry, Jack.
Yeah, all I was going to say, to be granular in terms of next steps for AMI, it's obviously getting through the process of going to tender and making sure you're doing that. You can use an EA. I would also recommend a building consultancy like Horde, our friend Alex Hearn. He has experience with designers, with delivering projects, and for the cost of the 5% of the contract, you'll probably save it in the mistakes that you would have made for the first few jobs that you do. You might not need that as you become a little bit more experienced. But one thing we haven't touched on here, which Stuart sort of almost got onto the point of, is this deal worth delivering in the first place? I've bought a building off the NHS. Everyone was looking at it to knock it down and build flats. The most profitable way to do that deal was actually to put a children's nursery operator in there for 10 years on a full repairing lease. And it was like all money out deal, 28% return on my, per annum, and to not develop it. So what I would recommend for AMI is to get a mentor. And what I mean by that is, let's just assume, for argument's sake, Ben and I were in a car incident and we've got an array of projects that need delivering. I would feel comfortable that you three guys that are on this call would have my best interest in the project, that would also be capable of delivering the project and would deliver it successfully. So you've got to think, who can I lean on to help me from a holistic perspective? Because the numbers might not even be right to deliver the 8-unit schemes. And it sounds like, obviously, Ami's running a successful accountancy business with his family, but that's definitely something you need to understand before you go to tender, or maybe even before you go to planning. So let's assume that you have done that. I would still be open to getting a mentor that's been there, done that, worn the t-shirt, because the issue with an EA, they don't give a fuck about the profit in the scheme. They will try and make sure the contract is watertight and the contract doesn't swing from its cost, but cost of finance, all the costs to get the site from a non-debt position to a debt position, dealing with banks, brokers, and lenders, getting pushed. There's so much that goes into property development. I think that an EA is it's your centre back of the team, but you need a manager. And if you haven't managed a football team before, you need that assistance. So I would 100% say get someone on board, even for a small shareholding, that knows what they're doing, can guide you. You will end up making more, larger amounts of a bigger pie, but a smaller amount of that bigger pie, because the deal 1 and deal 10 are learning the basics. You'll learn 80% of how to do development in the first 10 deals, and then you can start being a little bit more, keeping the deal for yourself and running it yourself. That's the only thing that I would add on to valuable points that you lads added already.
I'd add one more thing just for perspective. When we did our first site, and I'm sure all you guys have gone through exactly this. When we did our first couple sites, actually, but especially the first commercial to Resi, we let the Excel sheet dictate a lot of our decision making for the operations of the development. And in hindsight now, that's not the best idea. And I know that now I've got the experience. I know that it's worth that 5% to the consultancy practice like a Horde to come in, even though on your Excel sheet you go, oh, but I could save that 5% and just do it myself. But the do it yourself,
it's because your inputs, you don't know if the inputs are accurate, do you?
Yeah, exactly. Yeah.
Exactly.
Whereas that 5%, the do it yourself and save 5% could mean do it yourself and risk 20-30% in increased costs because of mistakes you might make. If you don't have the knowledge, and you've got to be honest with yourself, it's worth paying for someone else's knowledge until you've got the experience.
Like for us,
and have your own numbers.
Years, there's definitely deals that we've done in the past that if they came today, would 100% just not do. Not even just with hindsight. It's just the level of data and knowledge you get. You just say, you start knowing what actually is just not worth it. And so,
the knowing, right? The knowing is worth paying for, isn't it? It's worth paying someone for that knowing when they can look at a scheme, like Jack said, with this nursery scheme that could have been a nursery and is more profitable than redevelopment. If you've got someone with those eyes and that knowing, that knowledge, then it's worth its weight in gold. If it costs you 5%,
I mean,
that's worth
Jack is 100% right, and I think like you need a good broker, you need a good EA, you need a good or whether it's a building consultant, you need you need good assistants all around you with need good designers. Everyone you need needs to be good. But the problem is one of the key things Jack mentioned is like a mentor, somebody who's been there before that's had experience in all of those. Because, like as Jack, he's right. That one consultant or professional isn't really going to be that bothered about the rest of them. But to successfully deliver a project, you need all of them. And the only person who's really been there and done that will be a mentor. But I find it quite difficult to find people like that, because the one problem with mentors that you get as well sometimes is obviously they can be so experienced and so far in their career, but also their life is also in different stages. The advice they started giving is quite biased advice. That's also quite challenging because, and I don't know if anybody you can ever take your mind back to when you first did your first deal. It's so hard to listen to experienced people when you're at that stage. I don't know if you'll all. I'm able to look back and agree that I was probably given some advice that I just ignored or didn't believe, and I don't think you can change that from people. They have to go through and make their own mistakes. Was any of you the same?
Like having kids, D? Yeah, like having kids. You just never listen to people. Yeah, it's great. No, it's fucking not. It's hard work.
I completely agree. I mean, my dad's successful self-made business owner, and we had a row one Christmas because he was saying, why aren't you buying more green fields? Because one day there will be houses. And I'll be like, because I can't position and fund deals that are 30 years in the making. I'm here buying buildings that I'm in and out in 3 years. And we had this back and forth argument. If I had my time again, I'd have bought all these fields and, I'd have bought loads of open green land. And I understand his principle of what he's getting at. The suburbs are getting bigger, the cities are getting bigger, and the green land is where the real margin is. And I completely agree with him. But I don't want to be 30 years in a deal. I want to get around, turn the deal around and reinvest the capital. So we had this, and that was his advice. I completely disagree with it. But if I showed him a building and wanted to lean on his building experience, I would be like, more open and receptible to his advice from construction. But as far as business goes, he didn't understand why I wasn't. And we actually got pretty heated because I just wasn't backing down on it. I was like, I think that's a shit business model.
Your dad reserve the cost of capital. Your dad was right. To buy land was the best source of saving value. If you just wanted to park money into something that's not going to depreciate, like a house that needs maintenance where you have to spend the amount you've spent on the property, there's a certain amount of depreciation every year. But until Bitcoin, that land was the best thing. And there was a Michael Saylor done a keynote at the Nashville, which is well worth watching, Jack, because he was right. But yeah, if you want to run a business where you want to recycle cash that's not yours, then property is better.
the problem
but to reserve
with,
capital,
the problem I have, and this was the detail that we got down into, is if I bought land with surplus capital, it's sitting there earning zero. If not, the opportunity cost is costing me way more. Probably 1,000x on the capital for the 30 years that it's sat in there. Then eventually, when new settlement boundary comes out, and you go into the the schlar of a town, and you get 100 houses on there, and you make 18 million quid in one deal, but it takes 30 years from buying a site for £500,000. I want to get there in 10 years. So this is the argument I was having. Fair enough if I'm spinning off so much cash that I go, 30%.
That's the key.
That's capital value. You're talking about working capital. Your dad's talking about capital reserve. As a capital reserve, when you have got extra cash that you don't want to plough, rainy day fund, treasury asset, land was the best investment to make and has been for 1,000 years, just on how long it takes to spend the same amount of money you've invested on tax or capital gain. Everything, every other asset you can ever buy on this planet has got a depreciation value of over X amount of years. And not keeping it in cash, buying land was the best capital reserve, but working capital is a poor play. Yeah, like you're saying, spinning the cash to recycle until you get to that point where your dad has got so much money, he just wanted to buy land. And
this is where some of these people with other trading businesses that spin, they have their own working capital for their trading business, but then the business overperforms on that, and they can start throwing off cash to themselves, either in the business to build the reserves or to draw it down as dividends or for personal gain or whatever, and then taking that money and putting that into assets, as you say, land inclusive. It's definitely a smart play. But my position, similar probably to yours, Jack, we have these trading businesses ongoing that are in growth mode, that the working capital is purely needed for that business itself, and it doesn't throw off sufficient cash reserves as of yet. So maybe in a few years, Jack, when all of your 5 business, 6, 7, 8 businesses, how many of them you've got, are all throwing off cash left, right, and centre, you'll be out there like Bill Gates buying farmland up.
Buying some land,
buying a ranch.
What I kept
straw in the mouth,
What I kept reminding him about. What I kept reminding him, and I was saying to him, I was like, because it's one of his regrets. He regretted not swallowing up as much land as he could get his stubby little builder's hands on. But the principle that I'd always say is, you've forgotten what you've created from that capital that you would have invested in land. It's almost like
it's gone somewhere.
He reinvested it into his business, and that was super successful that he went on to sell. He did develop some sites, but they were probably more brownfieldy type sites. So, I agree with him, but completely disagree with him. And I find, and also to back to your point, Dorian, when people are on the grey hair scale of their career, they're way more risk averse, and they would, for example, they have done things that they wouldn't advise to do, but we want to do those things because we are younger, and
when I first started out in development, and obviously, I'm 100% not self-made. I've leaned on so many individual people with individual advices, but some of the people I've also potential mentors I've come across, they're much older. They've been in the property game much longer. They've been involved. But like, I remember very vividly one deal I was doing with an individual, trying to get them to help as a mentor, potentially JV. And they were so risk averse and so slow, and it was so pessimistic that for me, as my first deal, which is full of optimism and full of proactiveness and full of speed, the clash was just unbearable. So it's like, I know that's my own problem, but that is just something to remember as well. I remember.
If we're going to talk about that land strategy, then we got to mention that is what the PLCs do. Their margin comes from buying land with a 10-15 year view on it, around in strategic locations around certain boroughs, certain towns. And that is what your Persimmons and your Barclays and all those fuckers do.
Well,
that is
where Barclays were super sharp
as well.
But Barclays didn't even buy it. They just JV'd with National Rail and Thames Water and snapped up all of their sites on a JV model. And that's how they're on like 45% margins on their developments. It's absolutely insane.
Fucking nuts. Win-win. Wow.
Yeah.
Nice.
I mean, land plays, if you secure unallocated sites at just basically land value, a bare land value, and that has become developable land, the gains are astronomical. But like you say, It is.
You need big funding.
I think one of the reasons that Dorian touched on earlier today, that we're all not in big land sites, is because Dorian mentioned how difficult it is for us to fund a 3-year development that pays our team. Imagine going to an investor and saying, right, you're 65, I've got a 20-year position, which basically means whatever you make out of this, you can't spend anyway, because you're going to be fucked. Do you want to come on board? It's a great deal. and you've then got to sustain a business for 20 years to see it through.
Big funding partners. Should we go to couple more questions before we shoot off today, lads? Couple more.
Sounds good. We've got 15 minutes. 20 minutes.
So actually, this wasn't a question, but it's from Sep Simmons. Would love to come on the podcast. Appreciate the love. I actually checked out his account just to see what he was about, and he's similar to us guys, out there building houses, doing stuff for investors. Love it. So that's just a little
I know Charles. Charles is a good guy. He's got a very good business model as well. I actually went up to visit them, both Charles and Georgina. They're very switched on, motivated property entrepreneurs. I think they would definitely provide a good perspective to the channel for sure.
Yeah.
Are they new build? They're buying the big land.
They've done new build, I think, but there's mainly conversions into. They've got like a high cash flowing development model that they're doing.
They should go into big land. They should go into big land sites. They're doing the wrong thing.
Yeah, buy loads of land. Buy loads of it. But it was
so they do
a little bit of a presentation.
Say it again.
See if they can do a little bit of a presentation about their business, and we'll ask questions. It'd be good to see.
Yeah. Spread some light. I just I checked out their Instagram. Thought it was really well presented, interesting business. So nicely done, Charles. Next guy. So Dan Green _property. What he asks: what is the best advice you've ever been given about growing your business? So that's quite a topical conversation today. Stuart, do you want to start that one?
So I was just googling up. I'll just quickly Instagramming Charles to see what he's about. But yeah,
Jack,
what's the best advice you've ever been given about growing a business? Best advice, hire slow, fire fast. I think it's a big one. Cut out cancerous things in the business. If you've got any bad energy, get rid of it. If it's not in your alignment, I mean, it's loads. Go on, Jack.
Yeah, I've got one, which is mainly like the not Dorian's triangle of quality, speed, and whatever you call it. But the other triangle is profit, cash flow, and risk. If you have not factored or really considered the business model with all three of those elements for growth, you will not survive as a business fundamentally. So that's obviously cash flow to get to the profits and managing the risk. Also, if you haven't got all three of those dialed down and absolutely accurately, poignantly measured, monitored, scaled, spreadsheeted, your business won't work. And I think that's essential for growth.
Yeah. Nice.
This is what it's actually quite challenging because I've had a few like snippets of good advice pop into my mind. So if it's all right with you, I'm just going to rattle through them. One of them, which just comes from a book, which stays with me forever, is just a scaling up model of the 4 pillars. I literally think about every single day. Is strategy, execution, cash, and people. Those are the four ultimate. Those pillars need to be firing all in the green, basically, for any business to be successful. In combined to what Jack said about the profit, cash flow, and assets, but the other and the risk. But the other one I got as well is was like conflicting advice in the development game. The best advice I was always given was. Whatever my problems were, the answer always was, sounds like you need a bigger pipeline. So that was a good piece of advice that always stays in my head, and I also relate to my team. But then conflict into that is businesses. The other best business advice I was given was that businesses typically die because of cash flow. So protect cash flow. It's number one, which is absolute true. And then the last piece of advice I'll give is more of a stoicism advice. It's just one of my favorite sentences from the stoicism world, which is "This too shall pass." So anything that's hard, just remember this too shall pass. Just keep putting one foot in front of the other. Anything that's also good, though, remember that this too shall pass, which means that you're not going to stay on cloud 9 forever. So don't make any rash decisions based on you've just sold something for 100 grand. So let's go and buy a Lamborghini. It's going to pass. It's going to be so that's it.
Nice. Yeah, in the spirit of growing a business, I always, since you told me that saying, Dorian, it's always stuck in my head. I think one of your mentors, it was someone you consulted, wasn't it, about an issue you were having, and they said, you don't need more cash, you need a bigger pipeline, or whatever the sentiment was. And I think that always sticks in my head now when it comes to growing. I'm like, we do just need more work on the table, because if we know we've got more work ahead of us and more sales coming through the pipeline, we know we can afford to either profiteer our way out of any issues that we have, but also with scale, you get certain benefits that the economics of scale means you can do the problems you have now generally will get sort of drowned out because you then have newer problems on the horizon. So I do think in property development, especially, so long as your business principles, the fundamentals of your business, such as those 4 pillars you're on about and the profits and the cash and stuff. But if you're just looking at growing, then a bigger pipeline is the only thing you can do in property. There's no point waiting to finish that deal and be like, let's just get out of that one and then we'll think of the other one. If you want to grow, you have to start lining up deals in a way where you can forecast a 12 to 24-month run rate. Otherwise you just dry up super quick.
I would combat that with not necessarily bigger turnover is bigger profit. And that you need to understand your business size and what your like critical mass is for that business, because I agree the bigger you build the pipeline, but if every business has a perfect size to run at and where they punch above their weight in any industry in actual fact. So you want to make sure you're dealing within your critical mass. Just more pipeline isn't necessarily more net profit, because you might then be have different issues in scaling the team, and then the team might be big, then too big for those types of deals. So you've got to go again. So understanding those steps of critical mass is super important. If you don't know your gross profit margin, net profit margin against turnover, that is a big problem. So you've got to understand all of the numbers behind that.
And I think pipeline as well, the word pipeline as well doesn't necessarily mean deals. It's pipeline of deals, a pipeline of money, and pipeline of people, really. Those are the 3 key things you need for the business. And you, as any business owner, every day, really, in addition to all the other problems you have, you should really be thinking about those 3 pots of pipeline, really. And any day, or if you're a sales business, is that as well, pipeline of sales. It's just everything's pipeline, really.
Would you guys agree with this as well? So me and my dad especially are like continuously sort of scouting different people within our network and around our network who we think might be good plays for staff or resources down the road. And we know we're kind of always trying to look forward and go like, who we need at that point? Do we know anyone who's like who we could bring in from our existing network, or someone who's in the right sort of position? That's how we got Steve in. And there's other people that you can see. Just touch on that point of building pipeline. It doesn't have to be projects, but if you can see people that you can align with at some point, it also helps with that vision to actually come to fruition, because you know that if those people do join you and you are building something in a way that it does make sense for them to come and join, and you've got an existing network and rapport with them, it can be a really quick way to scale with trustworthy people rather than going to market every time and just seeing who comes in and the trial and error of doing that. I always think it's well worth just trying to preempt who are the next hires, who are the next strategic people you need in the business, partnerships, things like that, and trying to forecast those things in line with the growth of your underlying business. But yeah, next question.
Right, one sec. I'll just do mine quickly because I have listed.
Oh, sorry, mate. Sorry, I thought you did yours. Sorry.
No, I did. I just literally got caught off the half. So, best business advice, very quickly. Best business advice: grow slow, cash is king. The 80-20 risk rule: hire the best person for the role or the best person for the position. Turnover is vanity, profit is sanity. Profit first, and study Bitcoin.
Study Bitcoin, baby.
Hashtag study Bitcoin.
Love it.
That's all you need.
Bitcoin Maxi.
I am
nice.
Maxi.
All right, is from one of our good friends, Tyler Newman. So it's quite a big question. If you were to dedicate 50 years to solving one problem, what problem would it be? Starting with D. I'm sort of working our way up the video here. D, what would you say?
Well, I mean, ultimately for me, for the next 50 years, I can see, as long as I stay alive, that my focus and efforts is going to be all in the real estate property sector, to be honest. So all problems I'm going to be solving it's going to be relating to that. But there's no like so I would say that the problem I would like to solve over the next 50 years is how I can build a global property investment development company that's hedged against as many uncontrollable risks as possible, and is also outpacing and beating the returns of any other property investment development company. So how's about that for a challenging problem?
That is a challenging problem. What about you, Jack?
50 years is a bloody long time. So being selfish, I'd probably pick something that I enjoy. It's got to be in a nice climate on a beach, trying to solve whether pina coladas are better tasting than strawberry daiquiris. I don't know. I think that, as much as we'd love to dedicate 50 years to something, you have to be super passionate to dedicate 50 years to anything, because that is your whole life. So it's got to be something that I would, massively enjoy. What does that look like? Business. I enjoy business probably more than I do enjoy property. I like my bikes, so maybe something relating to motorized or non-motorized bikes. Who knows? Honestly, I also quite like a bit of spice. I'd love to, when I see what's his name, the guy from EastEnders, his brother, Phil Mitchell's brother, that goes around and does like prison stuff. I find that quite exciting.
Ross Kemp.
Ross Kemp, yeah, like any sort of challenge stuff, I think I'd find exciting. But who knows? I mean, I think that's because you either go, for the ESG, solve world hunger, but that's not really something that I'm good at. I'm not a good diplomat.
There's no hunger in Henley, is there, Jack?
There is hunger. Cash flow. We're all asset rich, cash poor. Old money. Old money, Dorian Payne.
I visited Jack in Henley, and I was walking around all the streets. I couldn't see one homeless person in sight. I thought,
food everywhere.
I actually got a call from the mayor that day saying, "Who's this Welsh guy, and why does he look so scruffy?"
Get him out.
Caught on CCTV.
Eating a Greggs.
Not local.
Funny story. McDonald's and Greggs have tried to get into Henley, and the council would not allow it.
Brilliant. I love that.
Too posh.
So Gales, Polino's, first cafe the Harrods ever brought outside of Knightsbridge, but no fast foodies. But yeah,
I rate that. That's cool. Stuart, 50-year plan, mate. Bitcoin, baby.
I think we all know what I do. Exactly that. It's sort the money, sort the world, fix the problems. And it is exactly that. I'm going to dedicate the next 50 years of my life to making sure that Bitcoin succeeds and telling everyone about it. And it's the trust, authorization, and transparency of money. You do fix hunger. You do fix third world politics. You fix everything with the money system. So that's what I'm going to do. And obviously, what comes off the back of that is a biggest wealth transition that humans have ever seen. So that's the long-term goal, and ultimately it's going to take away power from governments around the world, and that's where I'm so passionate about it. Not because I want to get wealthy out the back of it. I'm still I'm totally I basically I'm going to be building property that cash flows me, give someone a good place to live, somewhere that they feel secure, home, and that's ESG, that is eco-ready, it's environmentally friendly, and then any surplus cash that I get from that, my land banking with my capital reserves will be into this new paradigm shift, which is Bitcoin. That's it. That's what I'm passionate about.
Right, yeah, mate. Right. I mean, I do share every sentiment with Stu. I'm all in. I love Bitcoin. All about Bitcoin. But if I was to pick one that was about property, other than the moon, because I do want to fucking build on the moon, but we'll just put that to one side for a second. I do like the idea of trying to build the development business to a point where we can build, off the grid environments, whether that's individual houses or build to rent schemes that are off the grid, and trying to innovate our buildings, and obviously there's so much innovation that happens around the world. There's so much inspiration and technologies you can already draw from other people's tried and tested methods. I'd love to be a part of that and build buildings that are going to last and that aren't reliant on a centralized network of utility companies and all sorts of bollocks in the supermarkets. And I like, be sick to build like an ecosystem where they've got
community builder.
Yeah, and there's food resources there. There's water supply. There's energy supply. Like it's build these communities like that. I do love that. That idea would be cool. For now, it's a bit out of reach, but that would be cool to do one day.
So here's a question then. 50 years from now, I'm going to be 79. So just finally on that, How old are you all going to be in 50 years?
I'll be dead.
And no, you're going to be. I'll be 99 when you still.
I'll be 99. Yeah. No, I'll be 89.
89. How was it? Sorry, 89. Yeah. So we're all going to be in.
I'll be 83.
83.
Ryan will be in a boy band.
78. I'll be back in a boy band.
Ryan
living it
Ryan
up.
will be like that guy from Queen. Who's the one who's still rocking and jumping around the stage?
What, Freddie Mercury?
No,
Brian,
Brian, the guitarist.
Brian. Yeah.
So what, if you were at that age, what would you like at this age now? What would you like to think that when you were at that age, you would have accomplished?
Doing on the moon. Done something on the moon. I swear it as well. I swear it.
Army community. A bit like Rye saying, I'd love to do that, to build a property or an infrastructure or a new town that's been built that's totally self-sufficient, that you can go back to the 1920s where, or whatever. Call it what we like, but ultimately it'll be I would love to build a village in a green build that's totally actually carbon. It's actually benefiting society. That's probably run on Bitcoin.
What about you, Jack?
Yeah, I mean, mine's probably a little bit more humble, I think. Have a bigger Bitcoin wallet than Stuart.
Yeah,
that's a good strategy.
No, only joking. I mean, for me, I like the quiet life. So just be happy, healthy, and have a nice family around me, and sort of look back on. I'm more about the people around me than the things that they'll be living in or driving in. And also, I don't feel like I've been put on this earth to build, excessive communities and things like that. I think, I'm a little bit more humbled.
I'm not.
Nice. Well,
build the fucking world, baby.
Legacy, baby.
I think mine's going to be more company based, because I believe. Well, I'd like to think that as I sit here now in the future, by the time I get to that age, looking back, I would have accomplished, a national and a global property investment or development company, however that looks, in various different sectors, not just social housing, but social affordable care, other strategies, and build quite a diverse portfolio, but also have lots of different trading businesses all connected within its own ecosystem that combined is actually quite large, employs a lot of people. That in itself also gives me satisfaction, because I know employing people, providing a good workspace, does actually benefit local communities, does benefit and provides that kind of, I would say, ESG slice. But ultimately, at the moment, I think I'm going to actually be involved in businesses and growing them for as long as I think. But I did have a health checkup recently, actually, that did say that I've got, unfortunately, high cholesterol and a heart issue, which means I'm susceptible to, if I have high cholesterol, then I will, my arteries will block and I'll be at risk of coronary heart disease. So it depends how long that I can stay healthy. I need to sort my diet out, but the problem is eating good food is boring, so I am trying.
Drink whiskey, mate. Burns it out. Burns out the bloodstream.
Maybe spend some more time in the gym and not the sauna, and then you might that might
help. So got one last question here to go around the table on before we close out. This is from Jaden Marley. Jaden Marley, thank you for your question. And they've asked, what level of construction insurance do you have? Do you get external advice on this? Start with Stu.
Well, we're a contractor developer, so we're sort of both sides of the coin. Obviously, we've got all risk insurance. We make sure all our contractors have got public indemnity, all risk insurance for their particular part of the project. We've got obviously insurance for every individual project, which we need for the banks. So, I mean, I listened to episode 15 last night when it got released yesterday, and you done a whole segment on that, so I recommend going and listen to that about insurances, because I don't really get involved with that too much. We just get 3 or 4 quotes, we choose a premium that hits all the boxes, that's going to be good enough for the banks, and we move on. And like, if there is a black swan event and there is a tornado or a flood, we would hope that the one we've taken out is going to protect us, really. But more importantly, it's more about making sure you've got everything in line for the banks. When you're doing debt and you're doing deals, it's a lot easier because you are the controller of that site. You're basically taking the risk on your own shoulders, but the banks will dictate what insurances they want and who they want noted on it and all the rest of it. So we'll just do whatever it takes to get the deal get going and cancel it at the end. So that's what we do with insurance.
Go on, D.
I would say that so we're the same, obviously, contractor, developer, contractor. So our insurance is heavily led by either our funding lines or our clients. It will be specified. If we're doing a £5 million contract, we're going to have a contractor's all risk insurance that covers that. If it's timber frame, we'll have to cover that. So it's heavily led really by what we're doing. And then buildings insurance again is led by mortgages in terms of reinstatement value. One thing I would say though is that good insurance broker, go with a reputable company that will pay out as best as they can tell, and get as many risks covered as possible, because the insurance is one of those things we don't really like paying for it, because but when something does happen, when an event does happen, you will be so grateful that that you've got good insurance that does actually cover, because we've unfortunately been involved in several insurance claims, and it's really stressful and irritating, and it impacts your cash flow. But when you do get paid back out, you think to yourself, I'm so glad that I actually did have good insurance and did pay the premium. And that's the thing to remember, is everyone thinks it won't happen to me, but it could. It genuinely could, and it's a nightmare when it does. So you want to be covered.
And it's not cheap either. It's not cheap, these costs. So don't oversee them. Is it 20, 25, 30 grand, depending on the size of the project? I mean, it's big numbers.
Our insurance for the year at the moment, just in our construction insurance, is 110 grand a year, just for our contractors' insurance. Then we have professional indemnity insurance. We have JCT 6.5.1 insurance. We have buildings insurance. Like, we as a company, we spend probably well over 200 grand a year in different insurances. It's a lot of money. But equally, if anything happens across our sites, the risk of the claim is one claim could be in the six figures.
And this is exactly why I say that we keep ourselves lean and we don't have construction in house. Our insurance bill is about 1,200 quid per year, and that's our employees' liability and also company personal indemnity. All of our sites are insured with their own building insurance, which is in the SPVs that we insure. And then all of the contractual risk is on the contractor. So when the bank call us up and say, where's your contractor at risk report? We send an email to the contractor. They send it to us. We just forward it on to the bank. And that's why we operate as a lean machine.
Yeah. I'd say just all the same things that Dorian and Stu said. And obviously your insurance is usually portion of your is correlated with your turnover. So ours is about 18 grand a year, I think it is, in the construction business. All risks, I think, up to 10 million. But you need a good broker. So if you're out there trying to fish for it, don't take our advice. Go fucking speak to a good broker, speak to a few. And make sure
our insurance is so high because it's timber frame. That's one thing to note to people listening here as well, the material thing. If you're doing timber frame developments, it's actually quite difficult to get insurance, especially as it goes above a contract, a certain value, like 1 million or 2 million. And most of ours are above that, and they're all timber frame. So every single job we do has to be quoted for individually by insurers, and priced for it. And it's really, really, really expensive for each individual project. So it's actually a barrier. One of the barriers to construction I raised is that insurance to do it is expensive. Like, I think one job we had a £6 million timber frame job. The timber frame insurance just for the contractor's insurance for the timber frame was 50 grand. Nearly 1% of the job because of insurance.
Do you get what do you get in cars? When you go through the years and you don't claim on it. What's that called?
No claims bonus.
No claim. Do you get no claims bonus on timber? Because obviously, if you've done X amount of sites, you're like, they haven't blown down, they ain't caught on light, so you get a rebate. Premium. Yeah, rebate.
Well, a good broker should be able to find you a insurer that provides a rebate. So if you don't have a claim in a year, you get some of the premium back that you pay.
Right. Okay.
There's literally insurances for anything. We've actually looked at insurance against planning not getting approved. I don't know if you've
JR indemnity insurance. I mean, indemnity insurance world is a big. Well, it's one of the things. Every time an issue comes back with the solicitors, I'm always going back saying, "Can you get indemnity insurance for this?" Like, they never really offer it. So that's one thing a developer should always see.
It's crazy, and then you cannot then do anything about the issue, because then you'll compromise the indemnity position. So if there's a restriction, you can't try and get it lifted.
Can you get indemnity against the covenant? This is a question I've had recently.
Yeah, of course you can. Of course you can.
Yeah, we got some now.
Yeah. What kind of covenant?
What the covenant is.
So I think this covenant is about. So there's because that's what we'd usually do. Anything gets a title or anything like that, we go just see if you can get indemnity. But the solicitor came back and said we can't get it because it's a housing association that used to manage the property ages ago or own the property. They have an old covenant against it saying, and we need to lift that covenant before being able to use it as any other use class. And I was like, why don't we just get indemnity against it if we can't get hold of them or whatever? They're like, you can't do it. I was like,
One thing I know is solicitors they'll sometimes outsource indemnity, but there's also specific indemnity insurance brokers, and all they do is they focus on just indemnity insurances.
It's probably worthwhile us just quickly explaining, what we're actually talking about for the listeners. So if you're buying a site that is on a title, there might be a restriction or a covenant that's owned by someone or someone else on that site to restrict it in some way. So a common one that I have seen is if someone's selling a house that's on a plot that could potentially take 3 houses, they might put a restriction on that plot when they sell it that you cannot build any more than 1 house on that plot. What that then means is when you come to build 3, like us 4 greedy developers, they might be able to get a payout at that point and realize value for something that they've sold further down the line. And there's other phrases such as ransom strips, where developers or people take a strip of land and keep that ownership. And that's keeping a part of a title, but a covenant is against a title of a property. When you're buying a property and conveyancing, you should pick up these ailments with a lawyer. And we've had it before where we bought a site that we think we could get 4 houses on. There was a restriction on the title with it, which is a covenant saying that we could only build 1 house on there. I went to get indemnity insurance, which is an insurance company that are basically hedging a risk on that site on a payout. And if you ended up encountering the covenant owner, they would then have to pay out as an insurance. But the condition that they put in their cover is we have to get full planning permission first, because what that would naturally do is bring out the woodwork if anyone would, maybe a neighbor has a restriction on it, or maybe the person lives opposite. And during the planning process, they would raise their hand and say, I actually have a covenant on this site. And then your indemnity is obviously non-valid. So that's just an example of how you might go about it. Obviously, most covenants, the first question is, do we think this person is alive? Exactly. Quite commonly, they're not. And then you have to go into studying their estate and things like that.
It's like indemnity insurance may come up for lots of different things. Like if you're buying a house that's had an old extension, you can't find a building control notice for it. So that you need indemnity insurance. You might need indemnity insurance for that, for when you sell it on. If you've got an old boiler in there that you can't verify if that was approved by building control. And then obviously, Stuart, you probably encountered these with lofts in the past as well. And then it's about the same as Jack. We've done stuff with the restrictions on you can't build residential on it. We've got an indemnity insurance that kicks in if you manage to secure planning. So you structure the deal with the owner subject to planning to try to de-risk at your end, still risking the planning slice. But if it all comes off, you then go indemnity insurance and it covers you. So very important. But they are specialist brokers. That was the key part. If a solicitor can look at it, don't just kill it off. Just make sure you speak to a specialist indemnity insurance broker first. They may be able to source you one.
Yeah. Just on that loft one, we had a loft conversion a few years ago that was built on a farm. It was now an estate. You'd never know. It used to be a farm, but there was a covenant to say these houses can't do anything to their lofts or roofs. So we went through the planning process, got the planning, was about to start, and the day before the scaffolding was going up, they got a letter from a solicitor saying you can't do anything to these houses. And you'd never know. It's like they're like 1960s council house looking, but they couldn't do anything. So even though you can get planning for something, doesn't mean you can actually do it, which they were heartbroken about and had to move. But yeah, you can get everything right. Issues as well. You can have rights. We had the one in Windsor. We've got the rear emergency escape. There was already a legal situation going on between HSBC and the tenants previously that owned the one to the left. The rights of way for the emergency was blocked. So they were already going for a legal thing. We took indemnity on that. Fortunately, trail finders bought the building, knew there was the problem and already had a solution in place. So we're just getting fire reports and engineering solutions to make sure everyone's happy that it can be checked, because it goes through another property. But in Windsor, it's so higgledy-piggledy. There's no rear access to a lot of buildings. But yeah, it's always good. The solicitor should bring that up in conveyancing, and then you make a call. Most of the time, we'll just say, take indemnity.
Beautiful. And on that note, guys, that brings us to the end of our episode. We've done well today, actually, keeping on time and managed to get everything off the agenda. So kudos to us. That's episode 17, which will be out in a week or two's time. And we release these episodes every Thursday at 5:30 a.m. on Spotify and YouTube. We're nearly at 400 followers on the Instagram and nearly at 250 subscribers.
We've got a guy that keeps leaving comments saying we need more diversity or some shit. I'm like, well, tell us what you want us to talk about, and we'll chat about it. It's no problem.
Yeah, innit? Drop us a comment and we'll talk about anything. And we'll try and spice up the episodes as time goes on. Get some more guest speakers on. I think that could be a cool thing to do. I still think it'd be a cool idea to get someone on. You know, the guy asked the question today about their specific site and the specific problems they had. It'd be cool to get someone on like that and almost go through their site with them and help them with troubleshooting any problems. So maybe we'll look at that as well in the future.
What about we get someone on that's got a business with some problems and they come on and say their problems, and then we shout ideas out of how they can overcome them as well.
Yeah. Something like that I think would be super cool. It'd be good learning lessons for us. We should hive mind some ideas and hopefully good for the guest and any viewers listening. So drop comments. Let us know if you want us to do this kind of stuff.
Also, someone's mentioned about presenting one of their projects. So I know that we do that between ourselves anyway. If someone wanted to bring a project up, run through the process, begin, middle, end, and then talk about their problems, and we'll just dive into what you could have done differently, or what you could do next time. That might be quite good.
Yeah, it could be cool. Yeah. Anyway, drop comments to us, guys, for ideas. Big love. Thanks for listening, and we'll see you in the next episode. Peace.